The Intelligent Investor by Benjamin Graham is celebrated as the definitive text on value investing. Graham's philosophy is centered on the principle of investing with a margin of safety, emphasizing long-term wealth creation over short-term gains. This book serves as a guide for investors to navigate the complexities of the market with a disciplined approach, focusing on financial education, patience, and an analytical perspective. Chapter 1. What the Intelligent Investor Can Accomplish. Graham introduces the concept of the intelligent investor, distinguishing between speculative and investment activities. He asserts that the intelligent investor can achieve financial success through disciplined analysis, a conservative approach, and emotional detachment from market noise. This chapter sets the stage for understanding that investing is not about beating the market, but about controlling the risks and making informed decisions. Chapter 2. The Investor and Stock Market Fluctuations. This chapter delves into the cyclical nature of the stock market and the psychological challenges investors face. Graham teaches that market fluctuations should be viewed as opportunities rather than threats. He introduces the concept of Mr. Market as an allegory for the volatile market behavior, advising investors to remain rational and not be swayed by market moods. Chapter 3. The Investor and His Advisors. Graham discusses the role of financial advisors and the importance of independent thinking. He cautions against blindly following the advice of experts without understanding the basis of their recommendations. This chapter emphasizes the need for investors to develop a solid foundation of investment knowledge and principles. Chapter 4. General Portfolio. Policy, the Defensive Investor. Focusing on the defensive or passive investor, Graham outlines strategies for building a solid, diversified portfolio. He advocates for a balanced approach to investing, with an emphasis on high-grade bonds and value stocks. The defensive investor's goal is safety and adequate returns, achieved through a disciplined adherence to investment principles. Chapter 5. Portfolio, Policy for the Aggressive Investor. Negative Approach. Graham identifies common pitfalls and areas aggressive investors should avoid. He warns against speculative and fashionable investments, emphasizing that a disciplined, analytical approach and skepticism are crucial for the aggressive investor. This chapter advises on the importance of recognizing one's limitations and the dangers of overconfidence. Chapter 6. Portfolio Policy for the Enterprising Investor. The Positive Side. Here, Graham explores the proactive strategies an enterprising investor can employ to achieve superior returns. Graham emphasizes the importance of looking beyond conventional investment avenues to identify opportunities that can yield higher returns, albeit with higher risks. This involves detailed analysis and valuation of stocks, seeking out undervalued companies, or investing in higher-risk sectors with potential for significant growth. The enterprising investor is encouraged to dedicate substantial time and effort to research and continuous education to refine their investment decisions. Part 2. Principles of Security Selection. From Chapter 6, Graham transitions to the principles of selecting securities, providing a framework for evaluating investments based on fundamental analysis. He stresses the importance of financial due diligence and the selection of securities that offer both quality and value. Chapter 7. United States Savings Bonds, a Boon to Investors. Graham discusses the attributes of U.S. savings bonds as a secure investment option for the conservative investor. Highlighting their safety, predictability, and favorable tax treatment, he presents them as an exemplary choice for the defensive portion of an investor's portfolio. Chapter 8. Security Analysis for the Lay Investor. General Approach. Graham outlines a framework for the average investor to analyze securities without needing the expertise of a professional analyst. He emphasizes the importance of understanding a company's financial statements, distinguishing between investment and speculative opportunities, and the necessity of a margin of safety. This chapter serves as a primer on fundamental analysis, encouraging investors to look beyond market trends and focus on the intrinsic value of securities. Chapter 9. Stock Selection for the Defensive Investor. For the defensive or passive investor, Graham presents criteria for selecting stocks that minimize risk and provide steady returns. He recommends investing in companies with a long history of stable earnings, strong financial condition, continued dividends, and a good growth record. Graham's approach for the defensive investor prioritizes safety and reliability over high returns, advocating for a diversified portfolio of high-grade bonds and stocks. Chapter 10. Stock Selection for the Enterprising Investor. The Appraisal Method. Graham discusses more aggressive strategies for the enterprising investor willing to devote more time and energy to managing investments. This includes identifying undervalued stocks through detailed analysis, focusing on companies with potential for growth that the market has overlooked. The chapter provides guidance on evaluating a company's prospects based on its earnings, dividends, assets, and future outlook, highlighting the importance of discipline and patience in seeking higher returns. Chapter 11. Detection of Undervalued Issues by Security Analysis. 3 examples. Through 3 case studies, Graham demonstrates how enterprising investors can spot undervalued companies. He delves into the nuances of security analysis, showing how a thorough examination of financial statements and market positions can reveal investment opportunities that offer a margin of safety. This chapter illustrates the practical application of Graham's principles, emphasizing the value of in-depth research and analysis. Chapter 12. The Pattern of Change in Stock Earnings and Stock Prices. Graham explores the relationship between a company's earnings and its stock price, discussing how changes in earnings can affect investment decisions. He cautions investors against overreacting to short-term earnings fluctuations and encourages a focus on long-term performance. This chapter highlights the need for investors to understand the cyclical nature of earnings and to differentiate between temporary setbacks and fundamental problems. Chapter 13. Group Studies of Earnings and Price Developments. This chapter presents an analysis of earnings and price trends across different industries and market groups. Graham uses historical data to demonstrate how various sectors respond to economic cycles, providing insights into market behavior. He illustrates how fluctuations in earnings can lead to disproportionate reactions in stock prices, underscoring the market's tendency toward irrational exuberance or undue pessimism. Through detailed analysis, Graham demonstrates the potential for investors to identify undervalued stocks by understanding the nuances of earnings reports and market reactions, emphasizing the importance of a disciplined analytical approach to interpreting this data and cautioning against making investment decisions based solely on short-term trends. He advises investors to use this knowledge to make informed decisions, balancing their portfolios across sectors to mitigate risk. Part 3. The Investor as Business Owner. After Chapter 13, Graham shifts focus to the investor's role as a part owner of the businesses in which they invest. He emphasizes the importance of corporate governance, shareholder rights, and the relationship between stockholders and management. Chapter 14. Stockholders and Managements. This chapter delves into the dynamic between shareholders and corporate management, advocating for active shareholder engagement. Graham emphasizes the importance of corporate governance, the role of the board of directors in protecting shareholder interests, and the need for transparency and accountability in company operations. An informed and active shareholder base is essential for ensuring that management acts in the best interests of the company and its investors, rather than prioritizing short-term gains or their own compensation. With this, he discusses the mechanisms through which shareholders can influence corporate policy, including voting rights, shareholder meetings, and, in some cases, proxy battles. Finally, he cautions investors to be wary of companies where management practices are opaque or misaligned with shareholder value, advocating instead for investment in companies with a strong track record of ethical management and shareholder-friendly policies. Chapter 15. A Study of Stockholder Management Relations in 2 Industries. Graham concludes with a comparative study of stockholder management relations in two specific industries, illustrating how governance practices can impact investor returns. He discusses the importance of understanding these dynamics when making investment decisions, as they can significantly impact a company's long-term performance and, consequently, investor returns. He explores the role of regulatory environments, market competition, and technological innovation in shaping these relationships. And finally, Graham emphasizes that a thorough analysis of stockholder management relations is crucial for the enterprising investor seeking to identify companies with the potential for sustainable growth and favorable investment outcomes. Conclusion: The Intelligent Investor by Benjamin Graham stands as an essential guide for anyone looking to navigate the complexities of investing. Graham's principles of value investing, emphasizing fundamental analysis, a margin of safety, and a disciplined approach, offer timeless wisdom for both defensive and enterprising investors. Through detailed chapters on security analysis, stock selection, and the investor's role as a business owner, Graham provides the tools necessary for achieving financial independence through intelligent investing. His teachings encourage investors to think critically, act judiciously, and focus on long-term success rather than short-term gains.